Thanks for watching this technical analysis Q&A video, and in this video we're going to talk about the benefits of technical analysis from a variety of perspectives. I know lots of people just say it's a bunch of voodoo and it's basically hocus pocus. I'm going to try and show you why that isn't the case and why it's something which you should add to your arsenal. In the final event, most of us, when it comes to investments, want those investments to do well, and we want them ideally to do well on a continual basis with minimal disruptions. When we see a period as we had in COVID, when almost all stock prices were decimated because of the uncertainty in the marketplace, that creates a tremendous barrier to future investment. And you can see that for the FTSE, since I started tracking in early 2017, that's when I have data of my own, the returns that you would have made are not much more than a small bank, the small returns that you get from a bank deposit in terms of compound annual returns. So the question is, if you had better information, would you do better than this? One of the ways that we can look at this is by comparing. If we just simply put our money in a tracker, as many investment advisors do and advise their clients to do, would we have done any better? One way to look at this is by comparing it. So, for example, if we look at in percentage terms how another stock could have done, a single stock, in this instance it's Rightmove on the London Stock Exchange. The orange line is the price graph for Rightmove and the bars are the FTSE. You can see that Rightmove had, similarly to the FTSE overall, a fairly sharp drop, but it covered significantly more than the FTSE did, and then also had another commensurate drop as the whole sort of economic tightening kicked in throughout the UK and we had to pay for COVID. So the story with Rightmove would have been to see this position, to invest in that period and to get out at this point and then to go into something different. Without some form of analysis base to help you to do that, how would you know necessarily where to exit? You could say on a fundamentals basis, as soon as we saw that there was an economic crisis looming, likely as not house prices would suffer. So yes, I get that, but the difference between exiting at this point and perhaps exiting at this point or this point is significant. The returns on your investment could have been completely wiped out. Let's look at if we'd invested in Lloyds Bank as an alternative. Now, if we'd invested in Lloyds Bank, in fact, the share price for Lloyds Bank only partially to date has recovered the impact of COVID, as we can see here. And net over that period of time, in comparison to an index being up 23%, on Lloyds Bank would have lost 42%. Rightmove would have been up 36%. So with investments, it's not simply a question of hold and hope. It's a question of invest, hold until it's a sensible time to switch, and then switch. So by example, if we'd been in AstraZeneca, the story there is very obvious, of course. They're the people who produced the vaccine that we predominantly had in the UK. And albeit that they've had a fairly turbulent time, as it became obvious that they weren't going to sell any more vaccines in volume, nonetheless, AstraZeneca is a large pharmaceutical. It has many, many different product offerings. And like most pharmaceutical companies, it has a fairly stable, in aggregate, long-term profile. So if you'd invested in AstraZeneca and got your timing right, you'd be 122% up versus the FTSE at 24. So on a compound basis, that 122 would be mid-teens over the same period. A much better investment. If we were somewhat more conservative and we wanted to be simply in something stable that we understand, even gold has had a much better run. In effect, as the period of COVID took over, gold and as a safe haven, people bought it and carried on holding, and it's not lost most of its value or much of its value since its peak at the end of COVID. After the shall we say, the initial concerns of COVID, because that wasn't the end of COVID at this point. So you can see that having a tool set that enables you to differentiate between what to hold, what to buy, what to sell, gives you a significant variance in terms of the returns that you would have. And the whole point of technical analysis is to help you to identify price and trends and turning points and exit points so that you can profit at the right time. Of course, it also, as a result of that, manages your risk, because you're not holding in a hope, you're holding with a definite purpose. If you are a short-term trader and you want to make money in short-term positions, clearly there's no way, let's say that we were talking about AstraZeneca, that you could profit from this move here, for example, unless you had a fairly clear idea that this was the bottom of this downward cycle and the upward cycle was about to begin. Technical analysis would have told you that that was on the cards. So you have the ability to both switch on a medium term, trade on a short term, or if you're just going to hold in the long term, at least know what is happening in and around you so that you can hold more comfortably. The other thing I would say, and I've chosen these examples deliberately, is that you can see that technical analysis holds true, and the skills of using technical analysis are equal for commodities, for stocks, for bonds, indeed for anything on any market. The principles are exactly the same. And the principles are the same because price moves according to sentiment, and sentiment moves in regular positive and negative cycles. That's how people behave. Anyway, many reasons to use technical analysis, predominantly that you can see trends and you can benefit from those trends, as opposed to having very ordinary returns if you were to follow what the majority of the fund industry recommends, which is to be in trackers. I'll summarize this video by saying the most important thing is to know what you don't know. We are always biased towards what we do know and tend to discard or not treat with any respect the things that we don't know. So as soon as we do know those things, they become knowns, and those knowns shape our perspectives. Our recommendation to all our clients is know what you don't know, or at least make endeavors to find out more. You'll be a much better investor as a result. Anyhow, I look forward to chatting to you in our next Q&A video. Ciao until then.